What if I told you that a handful of Wall Street approved funds are on a collision course with a mathematical reality? Projections for 2026 are showing something we've never seen before. Asset managers are forecasting that institutional demand for assets like Bitcoin and Ethereum is on track to consume over 100% of all new supply. When demand completely overwhelms supply, prices don't just go up, they can go parabolic. But this time, it's different. A massive shift is happening right under our noses. A quiet transition from a market driven by you and me to one dominated by Wall Street giants. And they have very specific, regulated tools they prefer to use. By the end of this video, you'll understand why only a handful of crypto ETFs matter, and why most investors will be looking at the wrong ones. I'm going to break down the funds to watch, the regulatory tidal wave that's making it all possible, and how you can get positioned before the real supply shock begins. For years, the crypto story was all about technology and retail adoption. That chapter is closing. We are now in what many are calling the dawn of the institutional era. This isn't just a prediction. You can see it in the data. By late 2025, institutional investors already represented a significant and growing share of the market. The core thesis for the 2026 explosion is a concept I call the Great Supply Squeeze. It's simple, powerful, and almost inevitable. On one side, you have the supply. Take Bitcoin. After the halving event in April 2024, the creation of new BTC is scarcer than ever. On the other side, you have demand. But it's not the retail-driven frenzy of 2021. This is a relentless, staggering wave of institutional capital. After the landmark approval of spot Bitcoin ETFs in January 2024, the floodgates creaked open. We're not just talking about hedge funds anymore. This is about wealth advisors, corporate treasuries, and the ultimate prize, pension funds and retirement accounts. Here's the key. These institutions don't buy crypto on exchanges. They buy shares in regulated, insured, and liquid ETFs. And the pace of their buying is breathtaking. In 2025, the demand from corporate treasuries and ETFs consistently outpaced the new supply of Bitcoin being mined each day. Asset managers like Bitwise have predicted that by 2026, these funds could be purchasing more than 100% of the new supply of top-tier assets. If that sounds impossible, stay with me, because this is exactly where most people misunderstand what a supply shock actually does. Think about what that means. For every new coin created, institutions are set to buy that coin, plus another one from the existing supply. This creates a supply shock unlike anything we've seen before. The ETFs are the bottleneck where all this capital has to flow, and the funds that capture this flow are set for an explosive ride. This isn't just about price going up. It's about a fundamental repricing of these assets as they become a cornerstone of institutional portfolios. And it's all being enabled by a huge shift in the regulatory world. For a decade, the biggest wall between institutional money and crypto was regulatory uncertainty. That wall is now being dismantled piece by piece, setting the stage for a dramatic shift in 2026. Here's what matters. Regulation isn't just getting better, it's actively pulling Wall Street into crypto. The most important example is the bill known as FIT21, or the Financial Innovation and Technology for the 21st Century Act. This bill passed the House with strong bipartisan support in May 2024 and is seen as the leading template for future crypto market laws. Its goal is to finally solve the turf war between the SEC and the CFTC by clearly defining which crypto assets are securities and which are commodities. The passage of a bill like FIT21 would be a watershed moment. It would provide a clear set of rules for everything from custody to trading, allowing major Wall Street firms to get involved on a massive scale without fearing surprise lawsuits. Analysts have directly linked the passage of such a bill to new all-time highs for assets like Ethereum and Solana, as it would remove the regulatory cloud that has hung over so many projects. These legal frameworks are building the foundation and providing the rulebook. They are opening the floodgates for a torrent of institutional capital to flow into a new generation of crypto ETFs. At the absolute center of this institutional stampede is Bitcoin. The launch of spot Bitcoin ETFs in 2024 was the starting gun for the financial world, and their dominance is only set to grow. By late 2025, spot Bitcoin ETFs held assets worth over $114 billion. For 2026, the key fund to watch remains the iShares Bitcoin Trust, IBIT. BlackRock's power in the ETF world is unmatched. Their name is a stamp of approval for conservative institutions. When a pension fund or sovereign wealth fund decides to allocate to Bitcoin, IBIT is often their first call. Its liquidity and the backing of the world's largest asset manager make it the default choice. In 2025, IBIT captured a staggering $25.1 billion in net inflows, far outpacing its competitors. But the story gets bigger. The real catalyst for 2026 is the potential expansion into retirement accounts. As regulatory clarity improves, many expect major wealth management platforms to allow their financial advisors to recommend these products, potentially unlocking trillions in 401k and pension funds. This is where the supply squeeze thesis becomes brutally effective. While Bitcoin miners produced around 450 new BTC per day after the 2024 halving, demand from ETFs and corporate buyers was often orders of magnitude higher. Some reports in 2025 showed this demand consuming nearly 4 times the daily mine supply, which means anyone waiting for a pullback was competing against institutions with no price sensitivity. This is the dynamic that has led various analysts to project Bitcoin's price into the $120,000 to $170,000 range. The play here isn't just about Bitcoin's price. It's about owning the main gateway for institutional capital. As this new era matures, most of the money will likely consolidate into the biggest, most trusted funds. While other Bitcoin ETFs like Fidelity's FBTC and the Grayscale Bitcoin Mini Trust, BTC, will also grow, IBIT is positioned to stay king, acting as the world's default Bitcoin holding. Quick check, do you think institutional demand can really overpower supply long term? Drop yes or no below. I'm curious where you stand. Bitcoin is the anchor, but the highest percentage moves often come after institutions get comfortable. Now here's the mistake most investors are about to make. Assuming the next winners look exactly like the first one. While Bitcoin is the undisputed king, the institutional wave is already looking for the next big thing. The two clear heirs, set to capture a massive secondary wave of capital, are Ethereum and Solana. The logic is simple. Now that institutions are comfortable with a Bitcoin ETF, they're asking, what's next? First up is Ethereum. Spot Ethereum ETFs went live in the US in the summer of 2024. And while their initial flows were more modest than Bitcoin's, they laid crucial groundwork. By late 2025, these ETFs had attracted significant assets, with total AUM standing around $18 billion, proving real demand exists. The dominant players mirror the Bitcoin space, with BlackRock's iShares Ethereum Trust, ETHA, and Fidelity's Fidelity Ethereum Fund, FETH, leading in assets. The real explosion for Ethereum ETFs in 2026 could hinge on 2 things. First, the passage of a market structure bill, like FIT21, would solidify Ethereum's status as a digital commodity, unlocking even more conservative money. Second, and more importantly, is staking. The potential for an ETF that offers not just price exposure, but also a yield from staking rewards is a game changer. This would make an Ethereum ETF uniquely attractive to the multi-trillion-dollar market of income-seeking institutions. But the real high-growth story might be Solana. Throughout 2025, the crypto world watched with anticipation as multiple firms, including Bitwise, VanEck, and Fidelity, filed applications to launch the first US spot Solana ETFs. While not yet approved, the sheer number of filings from major players signals that Wall Street sees massive pent-up demand. Why Solana? Because institutions see it as a high-performance tech play. It's the blockchain that consistently handles huge transaction volumes at low cost, making it a favorite for things like high-frequency trading and payments. For an institution looking for the next Ethereum, a Solana ETF is the perfect vehicle. Assuming approval, the same supply squeeze dynamic would apply, with analysts forecasting that Solana ETFs could also consume more than 100% of its new supply. A spot Solana ETF represents a bet on the future of blockchain infrastructure, packaged in a wrapper that Wall Street understands and trusts. And then there's one ETF category Wall Street isn't talking about yet, but history says these late entrants can move the fastest. Beyond the giants of Bitcoin, Ethereum, and Solana, there's a wildcard that could deliver an explosive return in 2026. XRP. The story here is a dramatic comeback thanks to a regulatory victory that has completely reset its investment case. For years, XRP was paralyzed by a lawsuit from the SEC. That battle ended with a settlement in 2025 that brought incredible clarity. Secondary sales of XRP on exchanges were not securities transactions. This ruling was the green light the market was waiting for and has cleared the path for potential US spot XRP ETFs. Several firms, including Grayscale, Bitwise, and WisdomTree, have already filed applications. While no spot XRP ETFs have been approved in the US yet, some futures-based XRP ETFs did go live in 2025, and analysts are watching closely. The bull case for a future XRP ETF is built on a few key pillars. First, there's the supply shock. AI models have predicted that a scenario with just $10 billion in ETF inflows, a plausible figure given the dedicated investor base, could remove billions of XRP from the circulating supply. This dramatic tightening could lead to significant price appreciation, with some aggressive models forecasting a price between $8 and $14. Second, XRP's core job is to act as a bridge for cross-border payments on Ripple's network, RippleNet. It has a clear, real-world use case that is already processing significant volume. Investing in a future XRP ETF is a higher risk, higher reward bet compared to Bitcoin or Ethereum. It's a bet that its legal victory will translate into institutional adoption and that its use in global payments will drive real demand. The anticipation around a potential ETF launch already has XRP positioned as a dark horse for an outsized explosion in 2026. This is where most people blow the entire opportunity. By chasing headlines instead of positioning correctly. This institutional wave is a long-term trend, not a short-term trade. That means trying to time the market perfectly is a recipe for disaster. The most proven strategy for building a position is dollar cost averaging, or DCA. By investing a fixed amount of money at regular intervals, weekly or monthly, into these key ETFs, you average out your purchase price. This disciplined approach removes emotion and ensures you're accumulating through the inevitable volatility. Remember, even with this massive institutional tailwind, markets don't move in a straight line. We saw periods of significant outflows and price drops in late 2025, even as the long-term story grew stronger. For a DCA investor, those pullbacks are opportunities. It's also critical to understand the risks. The bullish case for 2026 is heavily dependent on continued regulatory progress. A major risk would be the failure of a bill like the FIT21 Act to pass in the Senate. While it has bipartisan support in the House, politics can be unpredictable. A breakdown in that process wouldn't kill the institutional trend, but it could certainly delay it. Furthermore, the approval of altcoin ETFs for assets like Solana and XRP is not guaranteed. Delays or rejections from regulators could quickly deflate excitement. This is why it's generally safer to focus on ETFs from the largest, most established managers like BlackRock, Fidelity, and Bitwise, as they have the resources and influence to navigate the regulatory landscape. Your portfolio should reflect this risk. A core holding in a Bitcoin ETF like IBIT gives you a solid foundation. From there, you might diversify into an Ethereum ETF like ETHA for exposure to the leading smart contract platform. Finally, a smaller, more speculative allocation toward the potential launch of a Solana or XRP ETF could provide that high growth upside. The key is to think like an institution. They aren't day trading. They're making a long-term strategic allocation to an emerging asset class. The smart money is focused on the undeniable trend of capital flowing from the old world into the new, using these ETFs as the bridge. The institutional wave isn't coming. It's already here. And by the time most investors feel comfortable, the supply shock will already be priced in. The great supply squeeze of 2026 is a real, calculable event. driven by a combination of regulatory breakthroughs and an insatiable institutional appetite for this new asset class. We've covered the behemoth, Bitcoin ETFs like IBIT, which are the main gateway for this historic transfer of wealth. We've explored the heirs apparent, Ethereum, and the highly anticipated Solana ETFs, which are poised to capture the next wave of capital. And we've looked at the Wildcard, XRP, which could provide an explosive return on the back of its newfound regulatory freedom. While most people are distracted by daily price charts and social media hype, the smart money is quietly and systematically flowing into these regulated, institutional-grade products. The trend is undeniable. The opportunity is right in front of us. The only question is whether you'll be positioned before this becomes obvious. If you want to stay ahead of these massive institutional trends, make sure you subscribe and turn on notifications so you don't miss the next deep dive. Now I want to hear from you. Let me know in the comments below, which of these ETF categories, Bitcoin, Ethereum, Solana, or XRP, are you most bullish on for 2026, and why? Let's get the conversation started.